What if everything you've been told about money, government spending, and inflation is upside down? What if governments keep printing money even when it destroys the value of your savings, collapses currencies, and triggers economic chaos? Most people believe printing money is a desperate act, a last resort in a crisis. But history tells a much darker and more strategic story. Governments often print money because they want to, even when the consequences are devastating. Behind the headlines of rising inflation and market crash lies a hidden logic, one that benefits a small group of insiders while the public bears the cost. This isn't economic incompetence, it's a mechanism baked into the financial system itself. Today, we uncover why governments keep printing money, why collapses happen again and again, and who truly profits when the system burns. Setting the stage: money, power, and crisis. To understand why governments print money, we must first understand what money really is. For centuries, currency was tied to tangible assets: gold, silver, or tradable commodities. This limited governments; they could only spend what they had. But in the 20th century, everything changed. The creation of fiat money currency backed by nothing but government authority gave states unprecedented power. Governments could now create money out of thin air. This gave the illusion of endless resources and the ability to fund wars, bailouts, and social programs without immediate revenue. But here's the twist. Unlimited money also fuels inflation, destabilizes currencies, and can collapse entire economies. Yet governments keep doing it. Why? History offers clues. After World War I, Germany printed money to pay reparations, triggering hyperinflation that wiped out savings. Yet, just 2 decades later, other nations embraced similar strategies to fund debt and stimulate growth. The pattern repeats. Printing money creates short-term relief, long-term consequences, and opportunities for those positioned to profit. Origins: the power of fiat and DBT. The modern story begins in the 20th century. After the Great Depression, central banks learned that controlling the money supply could manage economies. Governments discovered that printing money could finance wars, infrastructure, and social programs without immediate taxation. Debt became a tool, and currency became a lever. The United States ended the gold standard in 1971. Suddenly, dollars were backed by nothing but faith in government authority. This moment gave the Federal Reserve and other central banks almost godlike power. They could expand or contract the money supply at will. Economists called this monetary policy, but in reality, it was a mechanism for governments to maintain control, fund spending, and manage debt regardless of the cost to ordinary citizens. Debt itself became a reason to print money. Governments owe trillions in obligations, and raising taxes or cutting spending would be politically dangerous. Printing money is the easiest short-term solution. It funds obligations, creates liquidity, and keeps the system alive, even when it sees collapse. The rise: printing money as a systematic strategy. The practice of printing money isn't random. It follows predictable cycles. Governments, in collaboration with central banks, expand the money supply during crises to prevent immediate collapse. When inflation rises, they promise stabilization. When markets fail, they inject liquidity. And when the public panics, new currency floods the system. Consider examples: the 2008 financial crisis, when the Federal Reserve printed trillions to save banks. Or Zimbabwe in the 2000s, where money printing caused hyperinflation and famine. In both cases, governments chose printing over structural reform. Short-term relief came at the expense of long-term stability. The mechanism is clear. Printing money redistributes wealth. Those with access to capital: banks, corporations, and government insiders benefit first. Ordinary citizens experience inflation, currency depreciation, and reduced purchasing power. This cycle repeats globally: crisis, money printing, collapse, bailout, and concentration of wealth at the top. The breaking point when collapse becomes inevitable, every nation eventually faces limits. Inflation spikes, currency loses value, debt reaches unsustainable levels. Yet governments often respond with more printing, not restraint. History offers lessons. Weimar Germany's hyperinflation in the 1920s wiped out middle-class savings. Venezuela's ongoing monetary printing destroyed purchasing power for millions. Even in developed economies, excessive money supply can trigger asset bubbles, wage stagnation, and hidden economic instability. The pattern is the same. Governments avoid unpopular reforms, print money to maintain appearances, and defer the pain, creating bigger crises in the future. Collapse is not accidental, it's a predictable outcome of the system. The fallout: who wins and who loses. When governments print money recklessly, the consequences are uneven. Ordinary citizens pay the price. Inflation erodes savings, housing becomes unaffordable, and essential goods rise in cost. Middle-class wealth diminishes while wages stagnate. The winners are insiders with early access to capital. Banks, corporations, and investors benefit from rising asset prices, cheap credit, and debt restructuring. Governments themselves often gain politically. They avoid immediate taxation or spending cuts that would trigger unrest. In essence, money printing is a tool of both control and wealth transfer. Failed fixes. Why the cycle persists? Why don't governments stop printing money? Because every alternative is politically or economically painful. Raising taxes triggers unrest. Cutting spending destabilizes services. Reducing debt requires austerity, which is unpopular. Instead, the system relies on temporary relief measures, quantitative easing, low interest rates, stimulus packages. These measures create the illusion of stability while setting the stage for future crises. Each solution is a bandage, not a cure, reinforcing the cycle of dependency on money printing. The irony is clear. The very act that destabilizes the economy, printing money, is treated as the only solution to the problems it creates. Modern parallels today's global money expansion today. The pattern repeats on an unprecedented scale. Global debt exceeds $315 trillion. Central banks in the US, Europe, and Japan print trillions to fund deficits and support markets. Inflation erodes purchasing power. Asset prices soar while wages stagnate. Emerging markets suffer currency collapses while the wealthy benefit from rising stocks and real estate. Even in developed countries, governments prioritize short-term liquidity over long-term stability. The cycle of printing money, creating bubbles, and managing crises with more printing continues, an endless loop that benefits insiders while exposing the public to economic fragility. Takeaway number 1: money printing is not a last resort. It is a deliberate tool governments use to fund debt, maintain control, and stabilize power. Takeaway number 2: collapse is predictable. Currency depreciation, inflation, and financial instability are inherent outcomes of continuous money printing. Takeaway number 3: awareness is essential. Understanding who benefits, who suffers, and why governments print money empowers you to protect wealth and navigate the cycles of modern finance. Closing warning: we are living in a world where economic stability is often an illusion maintained through relentless currency expansion. Every crisis is an opportunity for insiders. Every bailout, every stimulus, every printed dollar shifts wealth and power. The question is no longer if collapse will happen, it is who will profit when it does. If you want more in-depth analyses of money, debt, and the hidden forces shaping your financial reality, make sure to like, subscribe, and turn on notifications. This is Financial Codex, where we reveal the forces behind global economics, decode the systems of power, and uncover the truth hidden behind every dollar printed.